Hello, 503 MBA 503 students. This video is the third on financial statement analysis, particularly ratios, and it's going to be the shortest of the ratios videos because we only cover two ratios in this one. So, to your delight, it's a very short video. Okay, so let's go straight to the PowerPoint slides, and I'm just going to do a quick review. So, basically, there's four ratio groups that we look at. First of all, are liquidity ratios. These ratios measure a company's ability to pay off its current liabilities, meaning its short-term debt. Okay, and the ratios we're going to do today, there's only two. These ratios measure a company's ability to pay off its long-term debt. They're of most interest to bondholders, and we're going to measure the ability to pay off both the interest and principal on bonds. Next ones are shareholder ratios. These are really market ratios more than accounting ratios. However, there are some important accounting inputs to these ratios, and these ratios measure whether a company's stock is going up and its efficiency in paying dividends. And finally, there's accounting return ratios, and these measure the company's returns from an accounting perspective. These measure a company's accounting returns to investors as measured by the company's financial statements. Okay, so let's just do a quick review of the liquidity ratios. First, you have current ratio. This one measures your ability to pay off current liabilities, and it asks, do you have enough current assets to pay off the current liabilities? Obviously, the higher the better. The greater amount of current assets you have to pay off current liabilities, the better position you're in. Then next one is the quick ratio. This ratio only includes some current assets, and those are the most liquid current assets: cash, accounts receivable, and marketable securities. They're called quick assets because these measure your ability to pay off your current liabilities with the most liquid of your current assets. The third liquidity ratio are accounts receivable turnover. This ratio measures how fast you collect your accounts receivable, and you want to collect them as fast as possible. So the higher, the faster, the better. Now on top, we usually have, theoretically, you should have credit sales, but in some quarters it's become common practice to use total sales, and that's divided by your average accounts receivable balance. And I want to emphasize, every time you see the word average in these denominators of these ratios, you're going to take the beginning balance plus the ending balance divided by 2. So we're going to take beginning accounts receivable plus ending accounts receivable divided by 2. Okay. Then, final liquidity ratio is inventory turnover. The equation for this ratio is cost of goods sold, and that makes sense because cost of goods sold is the cost of your inventory that flows through as you sell it. Okay, so the cost of goods sold divided by your average inventory balance. Okay, now, like accounts receivable, all averages are going to be beginning plus ending all over 2. So this is beginning inventory plus ending inventory all over 2. Okay, so and this ratio measures how many times the company has sold its inventory. Obviously, you want to sell it as fast as possible. So the higher, the faster, the better. Okay, now let's go down to the leverage ratios. The first one is times interest earned. This ratio measures the size of a company's operating income relative to its interest expense. We call it TIE, times interest earned. Okay, a high T ratio means that there's some grammatical errors there. Don't worry about it. A high times interest earned ratio means that a company is earning at a level sufficient to pay off its interest on long-term debt. And that's obviously true. You want to earn 10 times interest, or you want to, even better would be 20 times interest. Now, so the higher the better. This ratio is a major input to credit rating firms. I should have put the apostrophe after the S. Debt ratings of companies. So this ratio, although very simple, is a major input into whether a company has a AAA rating, AA rating, et cetera, et cetera. Okay, finally, debt to equity ratio. This ratio relatively measures your ability to pay off the principal on long-term debt, and it's simply total liabilities over total equity. And the lower, the better. In this case, the lower, the better. Obviously, if you're thinking of lending this company money, you want to have shorter or lower levels of debt than higher levels of debt. Okay, so I'm going to go back here to times interest earned, and I'm going to go ahead and go back to the worksheet here, to the Excel worksheet we had on Pfizer. And there's your times interest earned ratio. And this one, it's an easy ratio, but sometimes interest expense is hard to get. I'll show you where they are, where it is on the Pfizer statements. So for operating income, they're both interest or income statement based ratios. So to get your operating income, we're going to go to consolidated statement of income, and you're going to see that's their income statement, and you're going to see that you're going to have, it says here, income from continuing operations before provision for income taxes. Okay, so what this is saying is that this is your income from operating your business before provision for taxes. Okay, so this is going to be our numerator. We could make an adjustment for this, a small adjustment. I'm going to not do it this time, but I may start doing it next time. But for now, I'm just teaching the concept. So there's your operating income. Okay, now your interest expense. I want to show you something that becomes a little bit of a nuisance in some income statements. Notice that there is no interest expense. There is no interest expense on this income statement. There is no interest expense. So, so I'm betting that the interest expense is buried in other incomes and deductions. Okay, and anyway, so where is it? Where do you find interest expense? And remember I said that there's 100 sheets, worksheets on this workbook. So somewhere in one of those worksheets, the interest expense is buried in some footnote. Okay, and so let's see where that could be. Okay, so we want a worksheet which gives us detail on other income and deductions. And believe me, you're going to see that you have like 8 worksheets that give you the detail of this account, of this line item, excuse me. And so let's go out here a little bit. And so notice I'm going to keep going past the consolidated statements, restructuring. Now you have other income deductions net, so that looks like a footnote. Let me explain it. Okay, and you'll see if you go to the third line, I don't know if you can see my pointer, probably not, but it says interest expense is, you go out, go to the third line down and to the right, and you'll see A1574. And if you go back through the explanation, that basically says interest expense for 2019 was $1,574. Okay, but let's go out and see if it's in a worksheet so we can pull the number there. Okay, and I'm just showing you to show you all. You see all these worksheets give you the details of the various accounts. This one I remember is way out there, and I'm going to go way out here. I remember it was past all the acquisition tables. There's your segment data, usual stuff. Let's see. Now you see you got all your worksheets considering all the acquisitions that have been done. Gives you detail probably on each acquisition. Anyway, let's keep going out here. And you see other income deductions N3. And there it is. There's my 1574. Okay, and I forgot to put the equal sign. What do you know? Okay, so I'm going to go way back to the start here. And I know this seems silly, but I'm going to make sure you understand that you should use, every time you do these, and you could move this table over, obviously, but every time you do these, you should input, whenever you can, from a worksheet. So anyway, so I'm going to go back to my ratios here. I know it's a pain. Next one will be so short. Okay, and I'm going to go equals. Okay, and then I'm going to go all the way back here. It's just a rule I have for myself, and it does work if you do a lot of this. I'm going to go all the way to how it here to equals. And I'm going to go back to N3. Almost there, actually. It means note 3, actually. N3 means note 3. Okay, go back to this one. And I'm just going to make that equal to that interest expense right there. Okay, so your times interest earned is 17,000, 12,000, really billions. Divide by that. So this is really good. Pfizer has operating income, which is 11 times and I'm going to label this times their interest expense. Usually 11, and I don't know the other parameters that we're talking about. You'd have to look at the whole situation. But apparently Pfizer is very capable of paying off its interest, so this would bode well for its credit rating, maybe up to AAA. Okay, maybe we'll see later on what the credit rating is. This is just an initial example, obviously. Okay, then debt to equity, just this is total liabilities divided by total equity. That's a fully balance sheet based ratio. So let's just go ahead and go over here to the balance sheet, and we'll go over one. Your total liabilities, both current and non-current, your total liabilities are right there. Total liabilities are 37,304. Okay, and your total equity is equal to, this is going to be decent in your total equity. You notice that your total equity is down here. That's 63,143. Okay, so remember that the higher, I'm going to put up here, higher is better, and I'm going to put here lower is better. Why is lower better here? Because you're asking yourself, how much debt do I have relative to real ownership in the company? And obviously, it's like credit card companies. They look at the total level of your debt. If you have too much, they're not going to lend you money. Same thing here. So if you have too much, the bondholders are not going to buy your bonds. So they're looking for low levels of debt. Okay, and so it looks to me, after I format this here, it looks to me like it's not going to be too bad because it's going to be less than 1. Okay, so you got 37,000 divided by 63,000. So this is saying that, and I'm going to leave the dollar sign there because this is saying that for every dollar of equity, this company only has, and I'll use, your company only has 59 cents of debt. So that's not bad. It's lower than 1, and you'd have to compare this to another company, which is what I'm going to have you do in your next assignment with respect to ratios. Okay, so this is pretty good. It's if for every dollar of ownership, this company has 59 cents of debt, and obviously that looks good from somebody who wants to lend you money. Okay, and so that looks good. The leverage ratios are very good. This company has $11 basically for every of income for every dollar of interest expense. That's more than enough. And Pfizer only has 59 cents in liabilities for every dollar of equity. The lower the better. You want less debt if you're going to pay off. So it looks like they can pay off both the interest and the debt. That bodes well. Okay, so I'll put this video up. These were easy videos, except for looking at interest expense. And the next video is going to be on shareholder ratios. And actually, those are not, we've got all the inputs up on top, so we'll just have to copy some stuff from the input information we did in the first video. Anyway, so I'm going to go off here, and I'll start the second video. I'll place this on YouTube. I know these are a little rough sometimes, but these are it's a first-time example, a first-time videos being put together. So next time I'll take all the kinks out. But these are first time specially made for you. Good afternoon.